Hi everyone, I'd like to welcome you to this VAT Masterclass with me, Neil de Costa. I am a senior tax lecturer at Kaplan, and what we do at Kaplan is we offer accountancy and training courses for all the finance qualifications. So let's get cracking, taking a look at this VAT Masterclass. So in terms of VAT, VAT is a sales tax imposed on the final consumer. Okay, so VAT is a sales tax imposed on the final consumer, and as I'm sure all of you are aware, the rate of VAT is 20%. Okay, so the rate of VAT is 20%. Now we call VAT on sales output VAT, and we call VAT on purchases input VAT. So VAT on sales is called output VAT, VAT on purchases is called input VAT. Now, if you sell a zero-rated sales like exports, you're not going to have any output VAT, because obviously your final customer is outside the UK. But you're still allowed to claim back input VAT on your purchases. So if you sell zero-rated sales, you can still recover input VAT on your standard rated purchases. Alternatively, if you sell exempt sales like finance or insurance, so finance and insurance are exempt from VAT, there's no output VAT on finance and insurance, you're still allowed, you cannot claim back input VAT on your purchases. Okay, so banks, insurance companies cannot recover input VAT on their standard rated purchases, but export companies, companies that sell zero rated sales, can still claim back input VAT on their purchases. So let's take a look at a question which will have different types of supplies, and this question will help us understand how VAT works. So with the first company, Pear, we're told Pear is a trading company selling office stationery. So in the case of office stationery, this is standard rated. Okay. So office stationery is standard rated. And the annual sales are 200,000, while its purchases are 120,000. Now the sales are VAT exclusive. So when if you see the term VAT exclusive, what it means, it doesn't have VAT, but the purchases are VAT inclusive. So the purchases of 120,000 do include a VAT. So let's look and see how to deal with this. So all we're going to say for Pear here, the output VAT is simply 200,000, and the 200,000 is VAT exclusive. So exclusive means it doesn't include any VAT. So all we have to do is multiply that by 20%, and that gives us output VAT of 40,000. And then we say less input VAT claimed back on purchases. So less input VAT claimed back on purchases. Now we have to be careful with the purchases, because the 120,000 is VAT inclusive. So what we're going to say here is 120,000 multiplied by 20 over 120, okay, because it's VAT inclusive. Now 20 over 120 can be simplified to 1 over 6. So, so 120,000 times 1 over 6 is 20,000. So because we sell standard rated sales, we are allowed to claim back 20,000 input VAT on our purchases. And what that means is the VAT payable will be 20,000. So if we have a business that sells standard rated sales, what happens here is you work out the VAT on your sales at 20%, but you are allowed to claim back input VAT on your purchases. So what we say is output VAT less input VAT to give us the VAT payable, which is 20,000. The other example is we've got Strawberry Limited, and Strawberry Limited is a trading company selling exports. Now what we said about exports is we said exports are zero rated. The interesting thing about exports is even though they're zero rated, they're still treated as taxable supplies. So the export company is allowed to claim back input VAT on its purchases. So let's now deal with export company. So the export company sells zero rated sales. So here we can claim back input VAT. So what we're going to say here is output VAT, and output VAT will be 200,000 multiplied by 0% because exports are zero rated, less input VAT claimed back. And I've kept the purchases the same, so we've worked out the VAT on the 120,000, the 120 is VAT inclusive, as being 20,000. So what would happen here is the company is due a VAT refund of 20,000. So export companies here are due to, they don't have a VAT liability. What export companies are doing is they're claiming back input VAT on their purchases. And because export companies are claiming back input VAT on their purchases, what they normally do is instead of preparing quarterly returns, they prepare monthly returns. The last example given to us is Apricot, and we're told Apricot is an insurance company. It's got sales of 200,000 and its purchases are 120. Now, as far as Apricot is concerned, Apricot sells exempt sales. Now, if you sell exempt sales, you're not allowed to register for VAT. So Apricot cannot register for VAT. It can't claim back any VAT on its purchases. So with Apricot, insurance is an exempt supply. And because that's an exempt supply, we cannot register for VAT. So here we cannot register for VAT, and we cannot claim back input VAT on purchases. So just to recap that, if you sell standard rated sales, what we've got to do is to work out the output VAT on our sales at 20%. So that forms the output VAT, but then we can claim back input VAT on our purchases. If you sell a zero rated sales like exports, because exports are taxable supplies, you can still register for VAT, and once you're registered for VAT, there's no output VAT on your sales, but you're claiming back input VAT on your purchases. And the last example would be an insurance company, a company that sells exempt sales. And here, with regard to the insurance company, because we sell exempt sales are not taxable sales, so you're not allowed to register for VAT, and you cannot recover input VAT on your purchases. Let's now take a look at compulsory VAT registration. So which businesses have to register for VAT? Well, when we look at compulsory VAT registration, we refer to two tests. The first test is called the historic test. And with regard to the historic test, if your taxable sales in the last 12 months exceed 85,000, then you do need to register for VAT. And what happens here is you notify HMRC after 30 days. So once your sales have gone above 85,000, you then have 30 days to notify HMRC, and you should be registered by the start of the next month. So for the time being, I want to just make sure all of you can understand the historic test. So let's take a look at a question on that. So what we're told here is we've got Sanchez. So we've got Sanchez here. He's got a coffee shop, and sales for 2021 are £6,000. Okay, so he's got sales of £6,000 each month. So the first 3 months thereafter, sales are £7,000 per month before increasing to £8,000 per month. And we're asked, when should Sanchez be VAT registered? So let's take a look at this. So what we're going to do is from January to March, his sales was £6,000 a month times 3, and that gives us 18,000. And then for the next 3 months, which is April to June, his sales are 7,000 a month, which is 21,000. So if we add that stuff up, we're only up to 39. So what we're going to do now, his sales are now increasing to 8,000 a month. Okay. So let's say July to September, Sanchez's sales are 8,000 a month, so that gives us 24,000. So 39 plus 24 gives us 63,000. Okay, so at this point his sales are still less than 85,000, and he does not have to register for VAT. So I'm just going to keep it simple. So as far as October is concerned, he's got another 8,000 sales to take us up to 71,000, which is still less than 85,000. November, 8,000 sales. That's still less than 85,000. And then finally for December, when we add the December sales, that takes us up to 87,000, which is greater than 85,000. Okay, so what we can see is up to December 2021, his sales are more than 85,000. So remember, sales for the 12 months to the 31st of December 21, are 87,000, which is greater than 85. And what that means is Sanchez has to register for VAT. And what happens here is he's got 30 days to notify HMRC. So he must notify HMRC by the 30th of January 22. So you notify HMRC by the 30th of January 22, and then he would be VAT registered from the start of the following month. So from 1st of Feb 22, Sanchez is VAT registered. So that's how the historic test works. So with regard to the compulsory VAT registration, under the historic test, the taxable sales in the last 12 months should exceed, you have to register if your taxable sales in the last 12 months exceed 85,000. And you notify HMRC after 30 days, and you should be registered by the start of the next month. So in this case here, what we have to do to work out when Sanchez has to register for VAT is we start adding up his sales. So this is called keeping a running total. So you keep a running total of Sanchez's sales, and you check to see when his sales for a 12-month period exceed 85,000. And what we found here is his sales up to December 21 went above 85,000, and consequently he then had 30 days to notify HMRC. So he had to notify HMRC by the 30th of January 2022, and then he's going to be VAT registered from the start of the following month. So that's how the compulsory test for VAT registration works. The next test we're going to look at is called the future test. And under the future test, if you expect taxable supplies in a single month to exceed 85,000, you need to register for VAT. Now, with regard to the future test, so what we're trying to say, just in 1 month, you're going to have these very high sales of more than 85,000. You need to register based on the historic test by the start of the month in which you're going to have these very high sales, and you must charge VAT on sales for that month. So what we're told here is, as far as Betty is concerned, Betty has a graphic design business with sales of 6,000 per month. Okay, so what you can see is in a year, Betty's sales are just 72,000, which is less than 85,000. So Betty doesn't have to register for VAT. But she then signed a contract giving her very high sales of 80,000 for the month of May 22. So for May 22, Betty will have sales in 1 month of more than 85,000. And we're asked, when should Betty be VAT registered? So as far as Betty is concerned, here Betty will have sales in May 22 of her usual 6,000, plus she's got this contract of 80, and that gives her 86,000 sales in a single month, and 86 is greater than 85,000 in a single month. And based on that, what HMRC want Betty to do is she must be VAT registered at the start of that month. So Betty must be VAT registered by the 1st of May 22 and should charge VAT on sales of 86,000. So that month in which you're going to have these very high sales, you do have to charge VAT on those sales. So under the future test, remember, you must be registered by the start of the month in which you're going to have these very high sales. So with the future test, you need to register for VAT if you expect taxable supplies in a single month to exceed 85,000. And you have to notify HMRC by the start of the month and charge VAT on the sales for that month. So the month in which you're going to have sales of more than 85,000, you have to charge VAT. Okay, the next thing we're going to do, so we've understood compulsory VAT registration. Let's now take a look at voluntary VAT registration. Once you start a business, once you start making taxable supplies, you can choose to register voluntarily immediately. Now, the advantages of this is you hide the small size of the business. So you're giving the impression that your business has sales of more than 85,000. Secondly, you avoid late registration penalties. And the main advantage is this allows you to claim back input VAT quickly. So the advantages of voluntary VAT registration is you can now claim back VAT on your purchases and your capital items quickly. But the disadvantages of voluntary VAT registration, so the disadvantages of voluntary VAT registration are that you have admin costs because now you have to submit your VAT returns. Secondly, the main thing to look for is your customers, because your customers may not be VAT registered. And if your customers are not VAT registered, it will make your sales more expensive. And the last disadvantage is you do have a risk of penalties if you're negligent or you commit fraud. So it's very important that once you register for VAT, you do realize that you have to comply with the submission of the VAT returns correctly and on time. Let's take a look at a little question that will help us understand how voluntary VAT registration works. So what we're told here is we've got Lisa and Fred, and they've set up an internet startup, and they've got sales of 3,000 a year. So what we're trying to say is their sales are below the VAT threshold, so they don't have to register for VAT. So there's no requirement for compulsory registration. But as far as Lisa and Fred are concerned, their customers are VAT registered, and they've spent 30,000 on, they've spent 20,000 on capital expenditure. Okay, so with regard to an internet startup, they need lots of computer equipment, and they've already spent 20,000 on capital expenditure. So we're asked to explain the implications of voluntary VAT registration for Lisa and Fred, and we're asked to then talk about the advantages and disadvantages of this decision and what our recommendation should be. So as far as Lisa and Fred are concerned, their sales, are less than 85,000, therefore no requirement for compulsory VAT registration. So there's no requirement for compulsory VAT registration. But we're then asked to explain the implications of voluntary VAT registration for Lisa and Fred. So they can register voluntarily immediately. And as far as they're concerned, if they register for VAT voluntarily, what you can see here is it will have no impact on the VAT registered customers. So as far as their customers are concerned, because all of Fred and Lisa's customers are VAT registered, even if they charge them output VAT on the sales, it will have no impact on the customers because the customers are all VAT registered, so they can simply claim it back. But the good news for Lisa and Fred is the advantages here is it will conceal the small size of the business. So it will conceal the small size of the business. And secondly, the other advantage is they can claim back input VAT on the capital expenditure. So they can claim back input VAT on the 20,000 capital expenditure. Okay, so those are the advantages for Lisa and Fred. And obviously based on that, because there are no disadvantages apart from compliance, what we would recommend is we'd recommend voluntary VAT registration to Lisa and Fred, because they will immediately be able to recover the input VAT on their 20,000 capital expenditure. So here we would recommend voluntary registration. So that's how voluntary VAT registration works. So in terms of voluntary VAT registration, you can register once you start making taxable supplies. The advantages here, it allows you to hide the small size of the business. It avoids late registration penalties, and the best thing of all is you can claim back input VAT on your purchases and capital expenditure. The disadvantages are the admin costs, and it's very important to look and see if your customers are VAT registered. So if your customers are not VAT registered, then voluntary VAT registration is not beneficial because it will make your sales more expensive. And finally, it runs the risk of penalties for negligence or fraud. Now, once we're registered for VAT, we can then recover input VAT on our pre-registration goods and services. So once you register for VAT, you can claim back input VAT on your pre-registration goods and services. In terms of pre-registration goods, you can claim back the input VAT on goods bought in the previous 4 years for business purposes, but the goods must still be owned at the date of registration. So if you've sold the goods prior to the date of registration, you cannot claim back the VAT. And in terms of pre-registration services, with pre-registration services, we can go back 6 months. And once again, the services must be incurred for business purposes. In terms of capital items, we can claim back VAT on pre-registration capital items bought in the previous 4 years as well, as long as the capital items are still being used by the business. So the nice thing about registering for VAT is you can go back and recover input VAT on goods, services, and capital items. So let's say, as far as Mudiwa is concerned, Mudiwa is a photographer whose customers are individuals. Okay, so her monthly sales have averaged 5,000 a month, so she's not registered for VAT. So what we can see, as far as Mudiwa is concerned, her annual sales are 60,000. So she doesn't have to register for VAT because she's under the 85,000 threshold. But her monthly business services are £500 per month, and she's got inventory and photography equipment that she bought 2 years ago worth 10,000. And we asked, what are the implications of Mudiwa becoming VAT registered? So as far as Mudiwa is concerned, here, if she registers, she must charge customers VAT, which will make her selling price more expensive. So what we're trying to say here is, because she's now got to charge her customers VAT, that would make her selling price more expensive. Now, what normally happens to businesses whose customers are final consumers or individuals is when they register for VAT, what happens is they can't very well increase the selling price to cover the VAT. So what they do is they absorb part of the increase in selling price themselves. So would need to reduce her profit margin. So Mudiwa would reduce her profit margin. But the good news here with regard to her expenses, she would be able to claim back VAT on her expenses. So she can claim back input VAT on her pre-registration services going back 6 months. Okay, so what we're trying to say here is once Mudiwa registers for VAT, she can claim back input VAT on the services she spent money on before registering for VAT. So she can go back 6 months so we're assuming these figures are VAT exclusive. Times 20%. So once she registers for VAT, the benefit for her is she can claim back input VAT on her pre-registration services going back 6 months, which is £600. And with regard to her photography equipment, that is capital expenditure. So with capital expenditure, you're allowed to go back 4 years. So Mudiwa can also claim back input VAT on capital expenditure bought within the previous 4 years. So capital expenditure bought in the previous 4 years, because clearly she's still using this photography equipment in her business. So it's 10,000. Once again, we're assuming this is VAT exclusive. In the exam, the examiner will always tell you whether it's exclusive or inclusive. So she can claim back £2,000 pre-registration input VAT on the capital items she bought within the previous 4 years, as long as she's still using it in the business. So these are the benefits of registration for VAT. So even though she's not obliged to register, she may choose to register voluntarily. So in terms of pre-registration goods and services, you can claim back input VAT on pre-registration goods bought in the previous 4 years for business purposes, but they must still be owned at the date of registration. In terms of pre-registration services, we can only go back 6 months. Once again, the services should be bought for business purposes. And in terms of capital items, we're allowed to go back 4 years as long as they're still used in the business. So here when you're advising a client about registering for VAT to claim back input VAT, you do have to balance that out with the fact that here her customers are individuals. So it would make her selling price more expensive, and she would need to reduce her profit margin to absorb part of the cost of VAT. She can't pass on the full cost of the VAT to the customers immediately. So that brings us to the end of this VAT Masterclass. I hope you've enjoyed this Masterclass on VAT from me, Neil da Costa at Kaplan. One thing, if you've enjoyed the way I've been teaching you and the memory joggers I've shown you, I have written a book called Advanced Tax Condensed, which has everything you need to pass the advanced tax exam in 150 full color pages with multiple images and Neil's tips. I offer free UK postage and packing. It's only available on my website, neildacosta.co.uk, so you can check that out. There's also another book coming out to cover the first tax paper called Taxation Condensed. So, you know, if you've enjoyed the lecture, you can check out these books. And I have introduced PayPal, which allows you to pay in 3 installments. So I hope you've enjoyed this Kaplan Masterclass on VAT. So I've done another masterclass on corporation tax. You can check that out as well. And you know, if you've enjoyed these videos, let us know. Okay, connect with us on social media. So you can also connect with me on LinkedIn. And you know, we wish you all the best in your studies.